Hi, everybody. Dave Armstrong, Monument Wealth Management. It's the 14th of August, and we're in the middle of a 500-point sell-off on the market. So I figured, what better time to cut a video? Thanks for tuning in, everybody. Today I want to talk about what's going on with this yield curve inversion and this news and what it really means to everybody. So first thing I want to do is put everything into perspective, okay? There are trillions of dollars of debt out there in the world. The last number I saw in the newspaper today was $15 trillion that are exposed to negative interest rates. Negative interest rates. That means you give the bank $100, they give you 96 back. I mean, that sucks. And it doesn't take an idiot to figure out that that's a bad deal, right? So where's the safest place in the world? It's the US. We have the safest bonds and the best paying bonds in the world. So here's what's happening. People are taking their money out of the negative interest rates environments. They're bringing it to the US. They're buying our bonds because we actually have a positive rate of return on the bonds, right? So here's what happens with bonds. When the price goes up in a bond, the yield comes down. So we're seeing the yields come down, which is causing this inversion. And it's because people are coming in, they're buying our bonds out of this negative interest rate environment. This is a distortion, okay? Just past October, the 10-year was at 3.3 with reports that, expectations it was going to go to 3.5. Now here we are, August. Okay, so a little less than a year later, and those yields have been cut in half. They have not been cut in half because the economic prospects of the United States have sunk to the bottom of the frickin' toilet, okay? And I'll talk about that in a second when I talk about earnings and things like that. But this is a distortion that's being caused by supply and demand, right? When the demand for something goes up, the price goes up. And it's just as simple as that. So I think this is a distortion. And so what's causing negative interest rates and what's causing people to come and buy the safest and best yielding bonds in the world? Okay, let's just tick off a few things that are going on in the news. We've got Hong Kong at the brink of an invasion by China. We've got Russia has a nuclear accident that kills 5 people. We've got North Korea popping off missiles. We've got a trade war with China, and we've got China devaluing their currency and being labeled as a currency manipulator. We've got Italy dissolving parliament and threatening to leave the EU. We've got Pakistan and India, 2 nuclear-capable countries, trading barbs across the border with each other. I mean, that's destabilizing. We've got Iran in their perpetual screwing around in the Gulf with oil tankers. We've got the looming decision on Brexit is coming in October. Germany, if it's not in recession right now, it will be in the next 3 minutes. You get my point, okay? My point is that this negative interest rate situation is not normal. There is an undeniable distortion going on, okay, with the supply and demand issue. And that's not to say that this inversion, which I think is a distortion, that's not to say there will be no recession. I mean, of course there's going to be a recession. The question is when, and the answer to that no one really knows. Okay, so I'm going to say something that I've said a million times before. I'm going to link some blogs down here in the show notes below where you can go read some more detail on what I was saying about this. But slowing growth does not equal a recession, both in the United States or in the world, okay? You can look at the ISM reports and you can see that manufacturing and services have definitely softened. In the August report shows that those things are definitely softened, but they are not in recession levels, okay? And earnings season, which officially ends tomorrow, the 15th, we've got 57% of all the companies that have reported so far. So let's just basically say that earnings season's over because it's over tomorrow. 50% of all the companies that have reported have beat their earnings estimates, 57%. If we were in a horrible economic situation in the US, that number would be a lot lower. I'm not saying it's great, I'm just saying it's not horrible either. And in fact, 57% of the companies have beat their revenue estimates, which is actually up from last quarter. Now, look, I'm not saying that that's the best thing in the world. But what I am saying is it's not the worst thing in the world. And again, slowing growth does not equal a recession, okay? Recessions are characterized generally by 3 things. You will see at least 2 of these things going on in any past recession. And it's a commodity spike, an aggressive Fed, or extreme valuations. Right now, we don't have any of those things. Okay, we have no commodity spike. Just take a look at the price of oil. No commodity spike. We don't have an aggressive Fed. In fact, they just lowered 25 basis points. Okay, and we don't have extreme valuations because the valuation on the S&P is almost dead on with its 25-year average. So none of those 3 things exist. By comparison, in 2008, we had an aggressive Fed in 2008. Remember, Greenspan was raising rates a quarter of 25 basis points every meeting. And we had a commodity spike in 2008. And then you remember the recession in 2000, early 2000s. We had extreme valuations with the tech bubble, and we also had a commodity spike in 2000s. And if you go all the way back to the recession from 1990, you had commodity spike and aggressive Fed. Okay, so again, today, none of those things. So keep it in perspective, all right? So want to recap real quick. We're definitely going to have a recession someday. That's just a given. I guarantee it. What no one knows is when. And this yield curve inversion is a terrible timing tool. Again, I'll link a blog below where I talk about what a bad timing tool it is. It may be a great predictor. It's not a great predictor of when. So how do we know when? Well, no one really does. And what I do is rather than engage in the game of guessing, I'm engaging in the game of probabilities. Is the probability of a recession happening in the next 6 months increasing or decreasing? Well, some of these inputs are definitely going to increase the probability that we are going to see a recession inside the next 6 months, but none of them have even come close to hitting a trigger level. Now, that could all change tomorrow. I doubt it. It could also not happen for another 2 years. But because inversion is not a good timing tool, I'm dealing with probabilities. And remember, there's no perfect timing tool for a recession, but they're good ones. I think ours is a good one. And right now, ours has not hit a level that warrants any sort of action or concern today, okay? And frankly, that recession model has done a really good job of curbing a lot of the emotional reaction to the news cycle and things like that over the past 3 years. Definitely there's been some bad news, but nothing that has shown mounting evidence of a recession increasing in probability inside the next 6 months. When it does, I will sound the alarm, okay? But for right now, the news cycle is bad, but the probability is increasing to a meaningful level. And I want to sign off just reminding everybody this with all of this news, okay? If things were so horrible in the United States, you wouldn't see a Dow that's up 10% year to date, and you wouldn't see an S&P 500 that's up 14% year to date. So let's keep everything in perspective. Reach out if you have any questions. We've got all these social media channels that we are putting stuff out on them. So subscribe to one or all. They all have their different flavor. Of course, you can subscribe to our blog. And then finally, if you have any questions or comments, please reach out to me, and I'll answer anything that you have. So thanks a lot for listening, and hope you guys have a great day.